Hey, fellow investors, have you ever wondered why you make certain financial decisions, even when they don't always seem logical? Well, that's where behavioral economics comes in to save the day. This fascinating field explores how psychological, emotional, and social factors influence our economic choices. Today, we're diving into 9 key lessons from behavioral economics that can seriously level up your financial game. First up, we've got loss aversion. You know that gut-wrenching feeling when the market takes a nosedive? That's loss aversion in action. We tend to feel the pain of losses more intensely than the joy of gains. This can lead us to make rash decisions like panic selling during market dips. Instead, try to keep a cool head and remember that market fluctuations are normal. I always remind myself that historically, markets tend to recover and grow over time. Next, let's talk about anchoring bias. This is when we fixate on a specific reference point, like the price we paid for a stock, and use it to make future decisions. For example, if you bought a stock at $100, you might be reluctant to sell it for $80, even if that's actually a fair price now. To overcome this, I try to regularly reassess my investments based on current market conditions and future potential, rather than getting stuck on past prices. The sunk cost fallacy is another tricky one. It's the tendency to continue investing in something just because we've already put time or money into it. I've definitely been guilty of holding on to a losing investment, hoping it'll bounce back. But remember, what matters is the future potential, not what you've already spent. Sometimes it's better to cut your losses and move on to better opportunities. Herd behavior is when we follow the crowd without doing our own research. It's tempting to jump on the latest investment trend, but this can lead to bubbles and crashes. I always make sure to do my own due diligence before investing, even if everyone else seems to be doing it. It's okay to miss out on some trends if it means avoiding potential disasters. Hyperbolic discounting is a fancy term for our tendency to prefer smaller, immediate rewards over larger future ones. This can make it hard to save for long-term goals like retirement. To combat this, I try to make saving automatic and visualize my future self enjoying the benefits of my current sacrifices. It helps me stay motivated to prioritize long-term financial health. Mental accounting is when we categorize money differently based on how we got it or plan to use it. For example, you might be more likely to splurge with a tax refund than with your regular paycheck. To avoid this trap, I try to view all my money as part of one big financial picture. This helps me make more rational decisions about spending and saving. Status quo bias is our tendency to stick with the current situation, even when change might be beneficial. In investing, this can lead to a set-it-and-forget-it mentality. While a long-term strategy is generally good, it's important to regularly review and rebalance your portfolio. I set reminders to check my investments quarterly and make adjustments as needed. The endowment effect is when we overvalue things simply because we own them. This can make it hard to sell investments or other assets when it would be financially smart to do so. To counter this, I try to objectively evaluate my assets as if I were considering buying them today. Would I still want to own this at the current price? Lastly, we have confirmation bias, which is our tendency to seek out information that confirms our existing beliefs while ignoring contradictory evidence. This can lead to poor investment decisions based on incomplete information. To combat this, I actively seek out diverse opinions and viewpoints before making investment decisions. It's important to consider both the pros and cons of any financial move. By understanding and applying these behavioral economics principles, we can make smarter financial decisions and improve our overall financial health. Remember, awareness is the first step to overcoming these biases. It takes practice and conscious effort, but the payoff is worth it. So, fellow investors, which of these lessons resonated with you the most? Are there any you've struggled with in the past? I'd love to hear your thoughts and experiences in the comments below. And if you found this video helpful, please give it a thumbs up and hit that subscribe button for more financial insights. Don't forget to turn on notifications so you never miss an upload. Until next time, happy investing.